Get my dollar trade playbook to learn how to position, profit, and protect during a dollar devaluation. Scan this QR code or click on the link in the description.
You know about concentration risk. The 7 largest U.S. stocks reached a combined $20 trillion in market value, an unprecedented 37% of the S&P 500. That's 55% larger than the index at its 2000 and 2007 peaks. It matches where the first index traded in April of 2017 and larger than the March 2020 COVID low. So we know all about this huge concentration risk. And you and I had talked about this super peak valuation, remember? So the super peak valuation that we talked about either last week or the week before, I'm not quite sure. It was a LaDuc compilation. And I showed you a big old chart of where we're going based on this 2026 forward earnings of $302 a share. Remember that? Right now, beyond super peak, this is where we're at. We're literally trading for 33.7 times future earnings. The 7 have pushed the index PE dangerously to over 27 times now. Yardeni has a little bit of a disagreement on this, and that's why I wanted to bring it in. But this is why we're talking about it, is because this CapEx spending especially is what's really pushing the needle, and they're consuming a huge portion of cash earned in operations. So that's why an AMD didn't do so well, because free cash flow is falling. Meta was down 50% year over year in free cash flow. Didn't hit their stock, but in AMD, it most definitely did. Well, Yardeni came out with this. I happened to just catch that today in my travels. And we're talking about S&P 500 annual 2026 EPS, for those who are into it, is $301. So we just talked about this 302 level as it relates to when Google had their earnings and such. I'm like, oh my God, we're getting closer and closer. So we could still move into that level, is what I'm trying to say. So in support of your argument that it's AI, crypto, blockchain, and nothing else, or whatever, that we could still move into these highfalutin valuations, it may not be done yet. Super peak valuation at 302 is what LaDuc was talking about. So that's all fine, but we can't, I don't think anyway, ignore the risks that can absolutely come in to upset that apple cart. So while we're looking at a trend time frame, I'm kind of a little bit more specific. I give a lot more kind of aura of volatility around the movements, and the market hasn't done anything wrong. And it still has my top 10 list of why it's still bullish. And one of those things has actually petered out quite a bit, which is mechanical buying. CTAs are getting exhausted. Vol control funds are getting exhausted. Corporate buybacks were massive in July. They swamped prior years before even 2006. So we got a lot of support, actually, surprisingly, in July from those buybacks. That can't continue at that same rate. Point is, we had and dealers, they're kind of a little tired too. So we have some of that in pause mode. So that makes the volatility on the intraday, or let's just say for the next few weeks, especially during August and seasonally weak months of August, September, and October, more event filled. It can move about a lot more. So before we had this ballast, this absolute ballast of mechanical buying. I have talked about it weeks and weeks and weeks. We have both shown the charts from the CTAs to the vol control to the dealer. Now we got dangerously close, very dangerously close to a gamma flip level. We popped down below it, went from Thursday peak into that Friday morning. 62.28 was the level that I gave clients literally Friday morning at 10 o'clock and said, it's done going down for now. VIX was then sold. Markets popped right back up to where we gapped down Monday. And so everything looks fine again. So that's the reflexive nature of this short duration market that we're in. But to try and get it moving into that super peak valuation, we're going to need more good news. And right now, a lot of it has been spent. So the fiscal all gas, no brakes. Well, if we have a shutdown in October, which right now is not out of, it's a wild card, but not so much. This is actually a strategic move potentially for Trump to come in and get power of the purse. Things are a mess right now in the Senate, and the Epstein drama is distracting. But the point is they're using everything they possibly can to create this chaos around appointments and the appropriations of the money that was passed in the OBBA, et cetera, et cetera. So we actually have, that's a break. We have Fed Powell, this is another area, who says we don't need to cut right now, but the market is saying, but look, employment's starting to worry us and you need to cut. In fact, they priced in cuts into the end of the year. So September has an 88% chance of a 25 basis point cut. By the way, they already put that in. Immediately, the 2-year yield dumped 25 basis points on Friday with the NFP job growth revisions. So immediately they repriced the market at the 2-year, which is saying Fed's going to cut in September. That's already a fait accompli. Now there are whispers it's going to be 1 full point, not a quarter by the end of the year. So the point is the market is weighing constantly the AI narrative with the earnings, this free cash flow hit that is happening at the top of the food chain because of CapEx. We've got fiscal, but we have a little bit of a hitch in the giddy long around how it's all going to be distributed, and it has not been resolved yet. And shutdown risks, believe it or not, will start to grow louder as we get into September. People are still on the beach and they don't expect the market to fall apart during earnings. And earnings really haven't surprised. They've beat the low bar. So we're looking now at what's going on with this drama, not just employment underneath the surface, which I've written about in length, so I'm not going to dig into that. But the point is, they've now got the drama of Friday. Trump is going to come and announce, as early as Friday, he said, who he will have as the new appointed Fed governor that he will want to get approved, I should say, to replace Kugler. So a voting member who has resigned same day as he fired the BLS director as a way to stack the Fed bench of loyalists to get rates cut in the future. But what good is that going to do if prices are rising, which they are, and employment is getting shed, which it is? So rate cuts are not going to save us. And more importantly, and then I'll stop my rant, this is a new regime change. If they bring in a Judy Shelton, if they bring in a Kevin Hassett, these two characters are, of course, Trump loyalists, but they're major regime change. This is not coordinated policy intervention like we're used to between.
How does the dollar react to that, Samantha? How will the dollar react to that?
Lower, which is the one ballast that helps equities stay afloat. So if we have a Fed overhaul, which is what Trump is trying to do, the Senate is trying to do, a Judy Shelton would absolutely advocate for. She wants the gold standard again. I mean, we're talking not what we're used to, which is QE, which is policy intervention of any kind to backstop a growth shock, sovereign debt crisis, dollar spike or yield spike. They come in with intervention. So if we do have a new Fed overhaul, which absolutely will happen after Powell leaves, but maybe even before, then how's the bond market going to react? So these are some of the unknowns that are more important to me than whether AI is going to produce revenue next year or in 5 years.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.